Okay, thanks. Thanks for coming back to the research forum. And I hope everyone enjoyed the morning tea and the very informed conceptual framework earlier of the day. That's a perfect segue for us to get into the first research presentation of the day about the topic, Goodwill. I don't know about you guys, that's a favorite topic of us in the office. And Eric, for anyone who knows him, is always passionate about accounting research and professions. We asked this question, why are you so hooked onto accounting research? And he told us he was in this undergraduate class about accounting theory, and the lecturer asked the question, is accounting art or science? And literally that's a question got him hooked onto the profession since then. So, well, let's see if we can find an answer to that question in the next session. Mark, definitely no stress on that. Please join me in welcoming Dr. Mark Wallis from the University of Queensland to present their study, How Do Firms Estimate Recoverable Amounts for Goodwill Impairment Testing and Empirical Investigation. Welcome, Mark.
Okay, thank you, Al, and thank you to Keith and Eric for the opportunity to present at this forum. So this is, you can see we've gone over to my UQ template. This is some joint work I'm doing with Professor Matt Pinnock at the University of Melbourne. And we're interested basically in, at this stage, kind of descriptive evidence for how a firm's basically, it says, how they applying the goodwill impairment test in AASB 136. So why are we interested in this? As you can see, I've plotted the most common key audit matters in Australia. This comes out of a report that we do with CAA and Z each year, so I'm also to promote that. But you can see that impairment testing is the most common key audit matter in Australia, and within that, impairment testing of goodwill or cash generating units is the most common key audit matter. So it seems like it's an area where auditors are spending a lot of time. And it's also appeared, I think, on every ASIC focus list since ASIC started putting those out. So it's also a fixation of ASIC. And as we're going to see, and you probably already know, determining the recoverable amount of a cash generating unit is naturally a kind of subjective process. So it's naturally kind of a difficult area of accounting. The other motivation is that we're very interested in how firms conduct valuation for financial reporting purposes. And this is sort of a key form of valuation that firms have to do. They essentially have to value one of their segments, one of their divisions, their cash generating units. So it kind of provides a good setting to get insight into how firms conduct valuation when they're asked to do that. Final motivation comes from the academic literature. So the academic literature has got a lot of evidence claiming that goodwill impairments are being delayed, that firms are delaying goodwill impairments by abusing the subjectivity involved in estimating the recoverable amount of cash generating units. So there's I've just cited two papers there, but they're by very prominent academic researchers, Ross Watts and Richard Sloan. So these have got a lot of citations, had a lot of impact. But this literature sort of has two main limitations. So it's largely based on the US, which has got a slightly different impairment test. There's no value in use under US GAAP. And then they also don't get into the actual sort of details of how firms have worked out their recoverable amounts. So they don't sort of say how are they overstating, how are they overstating the recoverable amount to avoid an impairment test, if they indeed are doing that. So they don't get into the actual assumptions that went into working out that recoverable amount. That's something we're going to do. So I think, well, you're all kind of accountants, so you probably already know this, but this is the basics of what's in AASB 136 or IAS 36. So firms have to allocate goodwill to cash generating units. They have to test the cash generating units that have goodwill attached to them for impairment annually. Recoverable amount is compared to carrying amount, and the recoverable amount is the higher of value in use, fair value less cost of disposal. So the idea is meant to be the value in use is the value the firm could derive from continuing to run the cash generating unit internally, and the fair value less cost of disposal is what they could get from selling the cash generating unit. So in practice, firms, of course, only determine one of these two in the first instance. And if it's higher than the recoverable amount, then they don't need to proceed and work out the other one. So value in use is very reminiscent of a DCF valuation that a investor might do. So I've sort of put a stylized version of a value in use calculation there. So a firm will basically have to forecast the net cash flows up to the steady state. So I've shown it there with 5 years. And they're encouraged to do this using pre-tax cash flows in the standard. They'll have to then capture the value of cash flows beyond the steady state using a terminal growth rate, which is G in that equation. And then they'll have to discount everything back to present value using a discount rate. And the standard calls for using pre-tax discount rates. So what we're going to do in the study is collect what we can observe, what the standard requires firms to disclose, which is the pre-tax discount rate that they've used or range of pre-tax discount rates, the terminal growth rate, and the forecast horizon. We can't observe the actual cash flow forecasts up to the steady state. Not many firms disclose that, but we can see what we can see. There are some differences between value in use and how a typical investor would value, say, a company using a DCF model. So the standard calls for using pre-tax cash flows and discount rates, but in practice, most people would use post-tax cash flows and discount rates if they were doing a DCF. The standard says that you're not allowed to include the expected benefits from uncommitted restructurings or enhancements of the asset, whereas of course you could do that if you were valuing a company, you would do that. And the standard also strongly encourages firms to use a maximum of a 5-year forecast horizon, whereas of course if you were valuing a company, you could set that to whatever you felt was most appropriate. And as I've said there, none of these restrictions would apply if you worked out fair value, because the fair value standard doesn't set a maximum forecast horizon or say that you have to use pre-tax cash flows and discount rates. Okay, so we want to know what's the current practice amongst Australian firms. So based on their publicly available information in their annual reports, how are they working out recoverable amounts for goodwill impairment testing? What kind of valuation assumptions are they making? And then how do those compare to what we might expect to see from valuation theory or from our own empirical estimates? And are the valuation inputs biased, as is kind of widely claimed in the academic literature? Okay, so methodology. So we've got a 4-year sample, 2020 through 2023. This is quite an interesting sample period because there's a lot of dramatic events in that period. We're looking at firms have to be Australian incorporated and listed on the ASX. We set a minimum firm size of 150 million total assets just to keep the data collection manageable. This is manual collection. And we required the firms to have material goodwill, so goodwill to total assets of at least 2%. So obviously the data is hand collected from the notes to the financial statements. We've got 1,034 firm year observations. You can see about the same number of observations each year. It kind of fluctuates as firms list and delist in the sample. Now, you might be wondering, why do we have so few firms? Because you'd think there's a lot more Aussie firms that have total assets more than 150 million. But a lot of firms don't have goodwill. So particularly firms in the extractive industries, as you might expect, energy and mining, metals and mining, they largely drop out of our sample. So you can see that the distribution of observations across sectors is a bit different than what you'd see for the whole Australian Stock Exchange. There's a lot less in energy and materials. Okay, so this is the frequency of goodwill impairments overall and for each year of our sample period. And you can see that I've broken that down. I've got two, I've got the blue and the red chart. So the blue one is where the firm's market value is less than its book value of equity. So these are firms where we might expect that an impairment is more likely because essentially the market value is saying that the company's assets are overvalued. The red bar is where the market value is greater than the book value of equity. So an impairment is less likely. So a few observations on this. You can see the typical frequency of impairments is about 25% for the firms that look like they need an impairment. You can see that the firms where we would expect an impairment to be more likely, the blue bars, they actually do take, they are more likely to take impairments. And you can also see that there was a big spike in impairments during COVID, which I guess you might expect. Don't know, depends on what you think. So there you go. Now, recoverable amounts. So the first thing we collected was what's the method that firms used in the first instance to determine recoverable amount. You can see that value in use is by far the most popular method. There are some firms that use fair value less cost of disposal. Some firms that use both methods. They might use one for one cash generating unit and another method for a different cash generating unit. Now, we also collected within the firms that used fair value less cost of disposal what fair value method they used. So these are based on the methods that are mentioned in AASB 13. You can see that the income approach is by far the most common. So that is interesting because it's not all that different than a value in use calculation, if you think of it. Both involve basically DCF, forecasting future cash flows and discounting them back to present value. So this strong preference for the income approach with fair value kind of make me sort of wonder what's the difference between using fair value with the income approach and value in use. So the standard tries to make clear that value in use and fair value less cost of disposal are distinct. But in practice, we found that it was often sort of a bit ambiguous and it would be quite, I think, confusing to investors. So when we saw firms applying fair value less cost of disposal with the income method, they made disclosures that looked very much like what you would disclose with value in use. And they often made the same type of assumptions that you would make with value in use, like sticking to the 5-year forecast horizon that the standard suggests for value in use. Now, I'll show you an extreme example of this type of thing. So you can see here, this is O Media. So I'm sorry if you're the auditor of O Media, I've singled them out. But you can see this is in their 2022 annual report. They're saying they use fair value less cost of disposal to work out the recoverable amount of their cash generating units. And they're giving the assumptions there. They're giving the terminal growth rate, the discount rate, the EBIT margins, which is great, revenue growth. And there's a 5-year forecast horizon is mentioned there as well. And the next year, we've got pretty much exactly the same type of disclosure, but now it's described as value in use. And in fact, the inputs, the valuation inputs are the same. So the comparative figures are the same, implying that the firm essentially viewed fair value and value in use as the same thing, at least fair value using the income approach. So I think to me as an investor, that would be kind of confusing as to why some firms are using fair value, why some firms are using value in use, but then seeming to apply it in exactly the same way. Forecast horizon, we collected this. So here I've graphed the longest forecast horizon that firms used in either doing value in use calculations or fair value less cost of disposal with the income method, because they basically apply those the same way. And you can see that there's a virtually a huge number of firms are just using the 5-year forecast horizon that's mentioned in the standard. Now, this is kind of interesting because does that mean that they would have used a longer forecast horizon if they felt they were allowed to? So they're picking the maximum, or are they using the 5 years that's mentioned in the standard as a heuristic, right? And not, sort of just anchoring on that. The other thing is in valuation theory, this is kind of a surprising result because we would think that the forecast horizon should depend on the growth opportunities in the cash generating unit. So if it's a young, fast growing cash generating unit, you might think it is going to be able to grow faster than its terminal growth rate for longer than 5 years, perhaps. So it is quite interesting to see this strong clustering around a 5-year forecast horizon. And it's actually a fairly conservative approach if you think of it. If a cash generating unit is expected to grow quickly and you're cutting off its forecast horizon at 5 years, you're sort of missing out on some extra value that CGU might have generated in the years after 5 years. Terminal growth rates. Here we can see most firms using a terminal growth rate between 1.5% and 3%. So you can see very few firms use high terminal growth rates. Now, the firms that did disclose how they picked their terminal growth rate largely referred to expected inflation. So they said, well, the RBA's cash rate target, inflation target is between 2 and 3%, so we'll just use 2.5%. Now, this is kind of a surprising result, though, because the Australian economy is probably going to grow faster than inflation in the long run, right? It's going to have real growth. So to see virtually, it's kind of implausible that all cash generating units are going to grow slower than the Australian economy in the long run. So to give you an idea, this is some comparisons to other types of growth rates. So I've got there that the third one's probably the most compelling. So the Treasury puts out its forecast for nominal GDP growth, I think out to 2060 or something like that in the intergenerational report. You can see they're forecasting 4.4%. So you would expect that, okay, some cash generating units, of course, will grow it slower than that, but it's surprising to see all cash generating units expected to grow slower than that. I've also put the median analyst long-term growth rate forecast for the firms that have analyst coverage. It's 8.7%. I wouldn't put too much stock in that. I think they're quite optimistic equity analysts. And we've also got the median EBIT growth for these sample firms, which is quite high. I think probably because maybe there was a low base with COVID. So I'm curious as to why the terminal growth rate assumptions appear to me quite conservative. Someone that teaches financial statement analysis, I say the terminal growth rate shouldn't be higher than nominal GDP growth that you expect in the long run. Here we can see firms are capping it instead at a lower level, which is inflation. So one possibility that I don't know whether this is true or not is that perhaps firms interpret that prohibition on including the effects of asset enhancement as meaning that they can't choose a terminal growth rate above inflation. Discount rates. So here we've got the frequency of the type of discount rates that firms disclosed. Now the standard is focused on pre-tax discount rates, but you can see that a lot of firms decided to provide post-tax discount rates exclusively, or they provided both post and pre-tax discount rates. And I would hazard a guess that this is because post-tax discount rates are a fair bit easier for investors to understand because they're comparable to weighted average cost of capital. Whereas a pre-tax discount rate, not sure how you would even interpret it. Most firms are backing that out of a post-tax valuation anyway. So despite what the standard says, the focus on pre-tax discount rates, we see a lot of post-tax. Some firms even disclose that they use post-tax discount rates to work out the recoverable amount, just ignoring what it says in the standards about using pre-tax discount rates. Here I've graphed the median discount rates. These are the pre-tax discount rates, and we've got the lowest and highest discount rates because firms usually disclose a range. These are the pre-tax ones, so they're kind of hard to interpret, sort of hard to compare these to anything. But you can sort of see there's a modest increase between 2021 and 2023, but perhaps not as much as we might expect, as I'll show you in a second. Post-tax discount rates, so these are kind of comparable to WACC. So these sort of make sense to me. You can see 9.5 to 10.5. So when I worked in finance, the joke was WACC is 10% plus or minus 2%. So I'm glad to see 10% is about the median. And you can see again a fairly modest increase in discount rates between 2021 and 2023. So one sort of benchmark we can think about is the risk-free rate. And in Australia, we typically think of the 10-year government bond rate. And it's gone through quite an interesting journey over the sample period. You can see that it fell to its, I think, probably the lowest level ever during 2020. And then it was raised sharply, it's increased sharply because the RBA's increased interest rates to fight inflation. So you can see a fairly large increase in the risk-free rate between 2021 and 2022, 2.24%. We could see that firms did not increase their discount rates as much during that same period. Now, my personal view is that this is probably because firms didn't respond to this big drop in the discount rate. I think they sort of said, we're going to think about what our discount rate will be over the cycle, rather than responding to the changes in the weather and the government bond rate. But again, this is not consistent with this idea that firms are being aggressive with their assumptions. They could have taken advantage of the low risk-free rate to lower their discount rates and therefore increase the value of their recoverable amounts. We also estimated WACC empirically. So obviously a limitation of this is we can estimate the WACC for the whole firm, but of course the WACC, the discount rate that's used is specific to each cash generating unit, but nevertheless, I think it's interesting to do this. So this is the difference between our estimate of the firm's discount or WACC and the post-tax discount rates. And here I think I've used the median of the highest and lowest discount rates that the firms use, but it's not that sensitive to that assumption. And you can see that the discount rates actually look conservative. They look slightly higher than what we would expect. Overall, you can see I've broken it down between the firms that we expect an impairment, or impairment's more likely in the blue bars, and the firms where an impairment is less likely, which are the red bars. You can see that there's not much evidence that firms are understating their discount rates, even if they look like they need to take an impairment. So to me, the discount rates looked slightly conservative. All right, so I've only got about a minute left, so I better hurry up. So what are the conclusions from this? So the recoverable amount assumptions look, if anything, conservative rather than aggressively biased to me, at least overall. Perhaps there are some firms that are making aggressive assumptions, but not overall. So as we saw, the firms that are using a fairly short forecast horizon, or they're capping it at 5 years, using, I think, a low terminal growth rate, and the discount rates don't look low relative to empirical estimates. There's an exposure draft out at the moment proposing changes to IFRS 3 and IAS 36. So we find some support for this. So it proposes abolishing the requirement for firms to use pre-tax discount rates and pre-tax cash flows. I think that's sensible. We found a lot of firms disclose post-tax discount rates and said that they didn't use pre-tax discount rates. And these are probably a lot easier for investors to understand the post-tax discount rate. They're going to be required to disclose whether their discount rates that they've given are pre or post-tax. That would be helpful. We found some firms where that was ambiguous. We couldn't tell if their discount rate was pre or post-tax. And they're going to remove the prohibition on including the expected benefits from asset enhancement, which might reduce the conservatism in the terminal growth rates, perhaps. I've already mentioned this, but what is the role of fair value less cost of disposal? A lot of firms are using it in the same way that they would use value in use. So it wasn't really clear what the difference was meant to be. We did see some firms using it where they explicitly said they are going to sell the cash generating unit. So and then they looked at transaction comparables and that type of thing. I would think that would be a more sensible use for this. So I personally would think maybe we should consider limiting fair value less cost of disposal to where the cash generating unit is expected to be sold. All right, so these are my final thoughts. So the 5-year forecast horizon makes me a bit uncomfortable as someone that teaches financial statement analysis, but okay, maybe I can't get reliable forecasts beyond that. I personally think post-tax discount rates should be required to be disclosed. I think they're a lot easier for investors to understand because they're comparable to WACC. And then this is pretty bold, but the accounting standards are based on accrual accounting, except for the cash flow statement. So why are we using a cash-based model like DCF? Why not use an accrual-based valuation model like residual income? And I better stop. I'm done. All right, thank you.
Thanks very much, Mark. And not mean to stop you, but surely if you have any question for Mark, anything he didn't have time to cover, feel free to send it through Pigeonhole. So now I would like to introduce the AASB board member, Moana Overton, to chair the panel discussion. So Moana is a partner at Deloitte and with more than 2 decades of experience. She has been with Deloitte in technical roles in Australia, New Zealand, and United Kingdom. And Moana specializes in providing accounting technical advice to firms and clients at the national level. So now all yours.
Thanks, Al, and thank you, Mark, for your presentation. That I think we all found that really interesting. For my sins, one of my roles at Deloitte for a long time was to lead our Impairment Task Force, which is a group of valuations and accounting technical professionals whose role in life is to try and support our engagement teams and our clients in navigating the complexities that exist in our impairment reporting requirements. Now, as a child, I was taught that one must not blame their parents for everything. So I'd just like to put it out there that the complexities of impairment testing and the color of my hair might have some correlation. You can do some research into that later, Mark. Anyway, I'd also like to thank our panel members for coming today. We've got a really great panel, and I'm delighted to introduce Ian Jedlin, who's the Managing Director of Kroll and the IVS International Valuation Standards Council Standards Review Board member. He's got extensive valuation experience, also in a prior life with KPMG. So I'm sure he's got plenty of experience to bring to the discussion if you'd like to come up and take a seat, Ian. And I'll follow that up by introducing Richard Stewart, OAM, who's a partner at PwC and a chair of, the chair of the IVSC Business Valuation Board, also with extensive experience in valuations for a range of assets across the practice, and I see in many countries, far more than were named for me. I'm assuming you don't actually want me to give the full geographical roll call, but it's long. I'd then like to introduce Rachel Poo, who is the Head of Group Statutory Reporting and Accounting Policy at QBE. She's responsible for monitoring accounting developments and assessing their potential impacts on the group, and actively participates in local and international forums discussing accounting developments. And we're very grateful to you for making the time to come here today. And last but definitely not least, Alison Brown, who's the Assistant Auditor General for the Audit Office of New South Wales, and generously comes with a lot of commercial experience as well on her CV from Westpac and KPMG, but also with a public sector lens, because if we think impairment is hard in the private sector, and nothing about being in the public sector makes it easier, I don't think. So thank you, Alison. All right, so I might start with a test question. Right, following on from the comments made around inflation and terminal values, really interested to hear thoughts from any of the panel members as to the impact of inflation and what you think the impact of our currently high inflationary economy should be on valuations.
I mean, I'm happy to have first go before I hand over to my fellow experts. First of all, thank you very much for having me. Really appreciate the opportunity to speak to you today. I think with inflation, often we see these within pricing models, so reflected within expected rates, and that then feeds into rate and cost assumptions in plans and forecasts that are then used in cash flow forecasts for financial reporting. And then following that, there's some judgment that then needs to be taken into account to consider how to reflect that within the terminal growth rates for financial reporting purposes. In a high inflationary environment, we might see, and I'd be interested in views on this actually, we might see more use of real cash flows as a basis for cash flow forecasts. And in that case, I think one of the considerations to remember there is making sure that the discount rate is done on a consistent basis with the cash flows.
I might just add to Rachel's comments. Can everyone hear me okay? I'm not quite top of the microphone. So there's a interesting divergence that can occur in the growth in the cash flows between inflation and the real growth in the short term, because it depends on the company's ability to pass through price increases to its customers. So you can have a divergence in the path or trajectory of cash flows from inflation in the short term, although in the long term, that's relatively rare. And there is one point that I wanted to pick up around the presentation, which is the difference in the long term between the published growth rates for the economy and other companies and the long-term growth rate, assuming most valuation models being inflation. That's because the long-term cash flows largely reflect the surplus profitability of the business after reinvestment. And most of the growth rate expectations incorporate a degree of growth that is not reflected in profitability above the cost of capital, which is what that long-term growth is supposed to reflect. So there's a bit of a basis difference between those two items, which is why you see that discrepancy.
Any other comments around inflation?
I think the only other comment is that if you move from a pre-tax to a post-tax discount rate, you need to think about your growth rate in the context of the discount rate that you're applying as well. And you can't apply the same growth rate to pre-tax discount rates. as you do post-tax discount rates. And sometimes people do.
Would you like a public sector lens?
I would love a public
Okay.
sector lens. Thank you.
We have very weird assets in the public sector. So most of the assets in the public sector end up being valued on an input model. So it looks at the cost of replacing the service potential of those particular assets. So inflation is a really big factor in that, because if the cost of your inputs rise, you can expect to have significant changes in the cost of your assets overall. And even for the for-profit entities, you know, like electricity generators and whatever, the replacement cost of their physical assets would greatly exceed the income that they can generate from them. However, those entities will be valued on their cash flows nonetheless, and they will pay dividends back to the government, and they'll pay income tax equivalents back to the government. So in a lot of senses, the for-profit entities have all of the problems that the other panel members talked about, but for the not-for-profit entities, which is a great part of government, they have a particular set of problems with inflation with that input-based model.
Fantastic. Thank you. So the next question I might, in the first instance, address to Mark, and then open to any other panel member who wishes to answer, but acknowledging that some may not. Obviously, all of this is happening in a highly regulated environment here in Australia. And the question that has been put by someone in the audience is, do you think it's possible that ASIC's constant focus on impairment is driving overly conservative assumptions?
Yeah, that's a very good question. That would be really interesting to empirically test for us as academics. How does the strength of enforcement in a country affect these sort of things, the conservatism or optimism in those valuation inputs? But yeah, I went through and hand collected what was on the focus list for the last 10 years, and I was stunned to see that that was like the number 1 or number 2 item on the list every time. So I do think that I think the auditors are focused on it heavily, as we can see with the key audit matters, and the regulator's very focused on it. And I think therefore there's an opportunity, there's a potential for a lot of opportunism with it, but because it's being so carefully watched, perhaps that doesn't end up happening. We don't end up seeing aggressive, or at least not systematically aggressive assumptions. Yeah.
I guess from a practitioner's perspective, I've been challenged both ways. So with our long-term assumptions, for example, we've been challenged as to whether it's too aggressive. We've been challenged as to whether it's too conservative as well. So I think perhaps in a general sense, maybe the answer is yes, but in reality, we do get challenged a lot on assumptions and making sure that it's reasonable and appropriate. And I mean, we just heard the first panel on the conceptual framework about, and one of the key concepts in there is fair representation. So yeah, we get challenged on being too conservative as well.
I think the issue is really around the evidence that's arrayed to support the valuation exercise. That is the main contention of ASIC, at least in my experience. So that does lend itself to a focus on justifying the various assumptions used, and to the extent to which that's made conservative is hard to judge, because it does come on, sometimes there's evidence that prevails that suggests the assumptions should be higher, but there is very much a focus on evidence. In my experience, the question really goes around what the impairment test provides to the market in terms of the information. And it's seldom actually about the number itself, but really around the preparedness of management teams to reevaluate their decisions with a degree of skepticism that is reflected in the way the market looks at it. So it's really a credibility test for management. And in that situation, I guess it would lend itself to being conservative in the exercise of your credibility test.
Absolutely. Would you like to add anything?
Do you want the weird public sector lens again?
Sure.
Well, we don't have a lot of goodwill because we own businesses that no one in their right mind would ever invest in. They don't generate enough income to cover the assets, plus which we grow our own business. So we very rarely would acquire a business, which means that you don't recognise internally generated goodwill. But I can see why impairment of goodwill, similar to impairment of intangibles in a cash generating unit, is a problem, because you can't rewrite them back in you can't re-recognise them once they're impaired. Whereas for all other assets, if you've had an impairment, if the value of your business goes up, you can reinstate the values of those assets. So it's a one-way trip. So I think, ASIC quite rightly has a focus on those particular assets because I think management is probably highly incentivised not to take those one-way hits too often.
Yeah.
Yeah, I agree with Richard. I mean, the difficulty with an evidence-based framework is that companies often make acquisitions based on a level of aspiration or a belief that they can do things. And then when you come back to do the impairment and you've got to have an evidence-based framework to support some of the assumptions, it's very difficult to do that. And the consequence of that is that you're more likely to take a conservative basis to it, particularly when you've got really high growth companies that you're doing acquisitions of. It's much more difficult to support that growth rate.
Excellent. Thank you. So we might move on. Mark, you touched in your presentation on terminal growth rates and their appropriateness, and particularly whether some of them might be too low or too conservative. But interesting question from a participant as to whether we should be using terminal growth rates at all, because they do assume that an entity or a CGU will continue to operate at a level into perpetuity and nothing lasts forever.
That would be very conservative, not having a terminal. Usually it's at least when you're conducting an evaluation of a public company, normally that's where most of the value ends up, is actually in the terminal growth rate, terminal value. So, I mean, I think all I can refer to is what do normal investors do when they price companies. And I can tell you, using, say, a terminal growth rate at inflation, you have a sell recommendation on most of the ASX if you try doing that. And I don't know. I mean, if it's a going concern, if it's a continuing CGU, a business, then surely it's got to last longer than 5 years. You can't just assume that it's going to be, I don't know, liquidated or something after that. So no, I can't imagine that.
So the further detail that was put in by the question was that most businesses only last around 10 years. I'm not sure from where that statistic might come. Would 10 years make you feel any better?
I mean, I think look, it's a crapshoot, right? I mean, this is why the standard says that, you shouldn't use forecasts longer beyond 5 years. It says they're likely to be unreliable. All forecasts are likely to be unreliable. So, I mean, we know equity analysts the errors that they make are quite material, right? When they're forecasting 1 year ahead. So, you're just gonna have to live with that. I mean, either don't do this type of impairment test or live with that possibility. But no, I don't know if you can have an arbitrary rule like 5 years or 10 years, or it should depend on the nature of the cash generating, at least in theory. Obviously, there's some practical considerations like how reliable the forecast would be. But yeah, it should, in theory, it should depend on the nature of the business that's being valued.
All right. Other views on whether we should abandon terminal growth in favour of something else?
I think that's a little difficult when you've got a fair value less cost to sell. If you're looking at a market value, and that's what the market assumes in the main. So if you would adopt something different to that, it'd be a bit hard to then reconcile that with market views.
Yeah.
Look, terminal growth rates will always be an area of complexity. And, we have models where we use terminal growth rates, where we use particular formulas that create a declining growth rate post that 5-year period, as we realize, because you might be in a super period of growth beforehand. The idea is that your cash flows ideally should get to a period of normality in the business. That's really hard to do. And you see in other industries like venture capital, they do a 2-year, 3-year, and then do a terminal growth rate. But to Mark's point, all the value ends up in the terminal value. And you've got more room for error, because an acquirer who comes in 2 years' time, what do? They do a 5 or 10-year cash flow to decide what they're doing and whether it's actually going to achieve that terminal growth rate. So, and you have other industries like extractive industries and property and long-held infrastructure. They all get modelled on 20-year plus cash flows, and people do that. And that's the norm for those industries around doing it. So, yeah, the answer, the simplicity is 5-year is a market norm. It's kind of done. It's sort of a de minimis. But you can take another view that to Mark's point, it has errors and it has assumptions that are not easy to validate, which is why you also have in IPOs, nobody forecasts typically more than about 1 year out, because if you go to the regulatory guide, from Prospective Financial Information, RG 170, they talk about the difference between what you can forecast and what you can't. So there's not a simple answer. There's no right or wrong in this. It's about doing the best you can in the circumstances of the particular organisation you're looking at and what you're trying to achieve.
Okay, and long-term public sector assets?
In terms of the for-profit entities, look, I think there's a lot of points that have been made about that terminal value, and it is tricky. I think you're sort of saying rational market participant places less weight on returns the longer they go out. So if you're looking at people who are buying a business, they tend to more heavily weight your early returns because they're more certain, and the more uncertainty you have as you look into your future, the more they're likely to be discounted. That said, I think it's very hard to put a time frame around things. 5 years is sort of, you go, okay, I'm reasonably certain at 5 years, but then you've actually got to then look at the business and look at how long it takes that particular product cycle to develop as well, because some products, so if you're growing trees, for instance, it will take you 30 years to get that product to market, and you're going to have certainty about, or reasonable certainty about your cash flows, providing you've got the crop in the ground, and they'll go out for a longer period. So it's very hard to put a hard and fast rule around it. And I think it really comes down to the certainty of the cash flows and really looking at your business and what the product is and how long that takes to come to market.
So moving on then maybe from discount rates and terminal growth rates, Rachel, I might start with you just around the complexity of cash flow forecasting. Can you give us some views around what the key complexities are there and the challenges that you find in practice?
I think we've heard a lot already about the level of judgment involved in coming up with this forecast and needing an evidence-based framework. And I suppose by nature, given the level of judgment, it's not always easy to evidence these judgments, particularly with long-term assumptions. We could base some of those on a normalized historical average performance, for example. We'd still have to then make an assessment as to whether that assumption is appropriate, based on the market cycle we're in. Are we still expecting to achieve the rates inherent in those numbers, for example? So that's definitely a big area of complexity, and having internal governance processes is really important to help us to ensure that anything that we come up with can be evidenced and supported.
Excellent. So the next thing I'm going to ask is one I know you can all do. Could we all get a little bit closer to our microphones, please? Someone's popped that in the Q&A, so I'm sure we can all do that. Does anyone else have views on complexity in the cash flow forecast, and I guess too how they interact with the other valuation parameters? We'll be interested to hear from Richard or Ian.
Well, you go first this time, Ian.
Thanks, Richard. Look, I think in part, I partially answered that in what I said before, but there is a piece where people spend a lot of time on the discount rates because you get a lot of disclosure on the discount rates in the financial reports, but you don't get a lot of disclosure around the assumptions, thank you, around that's underlying the cash flows. And in some ways that's more important. And to understand, and then when you look at those, again, getting down to the timeframes, if you've got industries that are highly intensive on capital, or they have assets that have a particular life, 5 years may not be long enough. And when you're thinking around the terminal value, you just can't think about the cash flow and the terminal value. You need to think about the future capital expenditure required to retain that revenue or grow that revenue in the future. So there are complexities, and again, you need to think about each company and what it does and how its cash flows are built up to understand it.
Indeed, Ian. I think the only thing I'd add to that is that this is not the only context within which people estimate future cash flows. There are many others. So annual strategic planning for a company that has got long dated assets will almost inevitably look at the pattern of cash flows over a long-term period of time, am I close enough to that? No? as will investors looking to invest their capital in those same industries. They'll look at cash flows over many, many years. So it is complex, but there is proven manners of people using techniques to resolve that complexity in a range of things. And all we need to do in these things is use the same methods that are used in those other contexts.
All right, thank you very much. And if I could just focus on forecasts for a moment longer, to what extent do we think the impacts of COVID are still playing out in those forecasts?
That's a pretty easy one, not that much.
Okay.
It
I
depends
would
on the
say-
industry to a certain extent.
Yeah. So you could talk about the Australian airports. They haven't got back to pre-COVID numbers yet completely, right? They're still slightly behind. And some of that's played out in the supply and logistics piece for them. And you take it, the airlines, they haven't been able to build planes in the same way. There's been shortage of pilots globally. And so all of that's manifested. So there is some pieces, but I think the biggest piece that COVID's done is it's changed people's thinking about supply chains and how they manage risk in that way.
It's probably changed the way people come to the office too, and changed the way industrial properties
Richard.
valued.
Richard
And
used to wear a tie. all
I
the
used to
time.
wear a tie all the time. That's true.
And any reflections on how we include assumptions around ESG type topics in valuations and cash flow forecasting?
How long have we got? There's a short answer, which is very much depends on the industry, because the most profound implications for market value are really in petrochemical and carboniferous industries. But that's not to say that sustainability isn't a real issue. Given our earlier conversation on terminal values, sustainability is almost implied in valuation definition. So that topic is incorporated to some extent in the estimation of cash flows, but the more specific considerations around ESG, there's not a lot of evidence to suggest the market's taking that into account, mainly because there's not a lot of disclosure that can differentiate between firms. So at the moment, it's probably a bit neutral, but as we see more and more disclosure, that will become more nuanced, but I don't know how that's going to play out because we've yet to see it.
And what I'd also add is what we're really seeing in a lot of the companies that I value, where they're explicitly including that in their estimation of the cash flows, whether that's increased costs to make their assets more resilient. If you're talking, around something like the state of New South Wales, around how they're looking at their bridges and their roads and their rail lines and making sure that they're resilient in terms of floods and fires in a way that they haven't had to in the past. So there's specific issues in the cash flows. And then you also see it in some of the forecasting in different industries where they're making sure that they're looking at what that will do to people's behaviours around and that effect on revenue around how they operate.
Okay. So the little thing up the front there's gone red. So I guess that's telling me that people want their lunch on time, which is completely fair. So what I'd like to do is ask each of you in turn for some key recommendations that you might offer to standard setters, researchers or practitioners around valuations and financial reporting. And to mix things up a bit, I might start with, as you've described it, the weird public sector view and move along the table that way.
The weird public sector view. Well, I guess for standard setters, we sort of, I know that you've had IFRS people on the board, and I know that you had Australian setters on the board. Now, the IFRS people sort of scope out the weird public sector, but the Australian standard setters scoping into their thinking, which is very nice of them. Now,
You're welcome.
There's lots of things that happen with public sector assets, and we're not using the income approach, so we're not doing impairment of goodwill. And in fact, the standards say that the fair value at balance date is not going to be impaired, and you accept that the fair value already includes physical impairments. For lots of assets that we have, somebody mentioned roads and infrastructure assets and buildings, all sorts of specialised assets that we have, rail. Those particular assets, based on an input approach, where we're finding that climate risk play out is in terms of the useful life that might be applied to it. So if your wharves, your jetties, your roads, you previously thought that they were going to last for 100 or more years, they might be looking at shortening those useful lives because recent experience would tell us that what used to be a 100-year flood event is now a 50-year flood event or a 20-year flood event. So they come down. Sometimes you'll see a council who thinks that they've got a road that's going to last 500 years and you'll just go, so you're the Romans. So look, there is a reasonable test there. And I think, people are starting to factor it in, but to your point, I think it's a very slow process. People are really just starting to get their head around exactly what climate impacts are going to be in terms of the assets that they've got on the books. I'll turn it over to somebody else.
Rachel, what advice would you offer standard setters or anyone else in the room about valuations and financial reporting?
I guess for standard setters, I know there is a project currently going on intangible assets, and the AASB has generally been really good with consultation. But just an observation that changing the way we have to measure impairment could become very costly. A lot of time is already being spent on this very complex process, and so consultation will be really, really key in any changes that might come out of that project. For practitioners, as a practitioner, there are three things that's probably been really helpful for me personally. First of all, it's disclosure. We've heard, disclose your assumptions to make sure that a user understands the basis for what's been disclosed in financial statements. Secondly, internal documentation as well of those assumptions because it really helps us ensure that all of those judgments can be supported and evidenced as well. And probably the third thing is just that robust challenge and review structure, whether that's a governance committee or a different structure that allows for that review and challenge of those judgments.
Wonderful. Richard?
Thank you. I think the movements that the IFRS Foundation have made in relation to the exposure draft are very welcome around particularly the definition of cash flows and the use of post-tax discount rates in value in use. That aligns much more closely to market definitions of value in use, which is essentially fair value less buyer-specific synergies or plus buyer-specific synergies. So that clarification is very timely. In terms of the future exercises in this space, I think the critical thing is to focus on what's the information that the market is receiving from these disclosures, because that will set the logic around how these standards are used by people to make a difference in companies. So I think that is all about making the cost and the benefit align. And at the moment, I think there's a perception that this is quite a costly process, but effectively all it's trying to do is introduce a degree of accountability around one of the more costly processes, which is when people buy and sell businesses in the name of their shareholders. And I think this particular area is, there's a huge amount of activity still to come in the area of M&A, and making sure that accountability is balanced with this complexity is really important.
So I fundamentally I agree with Richard. I think it's a really important part of the process that if companies are doing acquisitions and doing that part, that they need to be held accountable for it, and you need to find the most effective way to do that. And when people talk about the cost of doing it as a reason for not doing it, I think they should be doing that anyway in their internal management from an organizational point to assess how acquisitions they've done, how they've achieved and performed. So I don't go with the cost argument, really, from my perspective. What I do think, though, is you need consistency and clarity around what the guidelines are, so you don't get the confusion that came out with some of the things where some people post pre, some post, they don't explain differences in methodology. That clarity so that people can do in the work that Mark's done in that research gives us evidence for it. And I think going back to the ESG, you know, one of the things where people are looking for when they're looking for ESG is consistency of disclosure and information so that they can actually make judgments as a consequence of it as an investor.
Thank you. And Mark.
Um,
Work.
Well, I kind of gave some recommendations in my speech already. But look, I mean, I would keep what we've got now, but I'd probably just better disclosures is always the sort of answer that we tend to give, isn't it? As I said, maybe having all firms disclose post-tax discount rates so they're kind of comparable, and you can investors can compare them to WACC and see if they agree with them. There's not very good disclosure around the cash flows that firms are forecasting up to the steady state. Then they may not want to disclose that because it could be commercially sensitive. But it's sort of the market discipline and make them disclose what their assumptions are, and then just let the market and the analysts decide if it's reasonable or not. Might be all we can really do. Because as I said, I don't know that you can verify a forecast until it's already happened. When it's made, you don't know if it's reasonable or not. I guess it could be ridiculous, but the only way to do it perhaps is to fall back on the discipline of the market and say, let them give the market the disclosures and see what the market thinks of it, if they view it as credible or not.
Fantastic. Well, thank you, Mark, and thank you to all the panel members. That's been a really interesting conversation. I'm not going to ask you to answer this question. I might throw it back to the conceptual framework team from earlier, but I do love the question in front of me that says, valuing a relatively arbitrary set of assets is a time-consuming, costly and uncertain process. Do information benefits outweigh the cost? And let's discuss that over lunch. The next session will begin at 1:30, I believe. So look forward to seeing you all there and hearing some more interesting speakers. Thank you, and thanks again.